In this free masterclass, you will learn everything you need to know about indicators for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only understand how to use trading indicators to make money, but you will also discover multiple advanced techniques that most traders don't even know about. Alright, so hello everyone and welcome to this TradingView indicators course. This right here, I aim for it to be a masterclass around 1 hour long. So make sure guys to really lock in. You might want to grab a coffee, and I also recommend that throughout this course that you actually take some notes, because in order to get the most out of this course, I really recommend to pay attention, take notes. And I will also make sure to add video timestamps so you can easily jump through the course and rewind important parts. And I can also just mention that I have built this course in a step-by-step manner. So it is preferable if you watch all of the chapters in order, but if you want to, you can definitely feel free to jump around. I can also just mention that for this video, I have included some of my personal favorite indicators. So these are the best indicators according to me, but there are of course, other traders will have other favorites. But during this video, I will not only explain why I like the indicators so much, but I will also show you guys how you can change the settings of the indicators to potentially improve them even further. So make sure, as I said, to really pay attention and really lock in. But now, without further ado, let's get started. But right, so before we can start using indicators to make money, we of course first need to know what are indicators in the first place. And in very simple terms, indicators are simply just mathematical formulas that are based on price and volume that makes the charts easier to read. And this is one important thing that you already need to have in mind. The reason we are using indicators is to make the charts easier to read and to make it easier to do our technical analysis. If we use indicators and the charts become more complicated, that is, no good reason to use indicators. We want the indicators to help us with a more clear technical analysis. And indicators can be used, for example, to highlight trends. They can also show volatility, and they can even show things like key support and resistance levels. In this course, I will show you indicators that show you guys uptrends and downtrends. I will show you indicators that show volatility. In other words, how much is the market moving? And I will even show you support and resistance indicators. And one great thing about indicators is that they can show things that are not always obvious by just looking at the raw price data, by just looking at the raw candlestick chart. But here, and this is very key, indicators do not, predict the future. But what they do is that they help us traders make better decisions. And if we as traders can make better decisions on a consistent basis, that also means that we make more money in the long run. But right, so let's begin here right away by taking a look at the first indicator. And the first indicator I want to talk about is the RSI, or in other words, the relative strength index. Before we start using our indicators, it's very important to learn about the basics. You should always learn how the indicators work before you use them. So first of all, some basics here. The RSI was created all the way back here in 1978 by a guy called J. Wells Wilder. And what the RSI indicator does is that it measures momentum. And momentum is, simply put, the strength and speed of price moves. So if we have a chart that goes like this, and then we have a part that moves up like this right here is lots of momentum. While if we have a chart that moves like this and then the move is much smaller, this right here is less momentum. And here, to measure momentum, the RSI moves between 0 and 100. And one thing that beginners really tend to focus on is they tend to focus on that when the RSI is above 70, we say that it's overbought. And when the RSI is below 30, we say that it's oversold. And many traders think that values above 70, so overbought conditions, means that you should sell. And that values below 30, in other words, oversold conditions, means that you should buy. And this is completely wrong. And this is a very common beginner mistake when it comes to the RSI. I will show you guys this very soon when we jump into TradingView, but one of my personal favorite trading strategies, there are many ways to use the RSI, but one of my personal favorite is to use something called RSI divergence. And this is when the price and the RSI moves in opposite directions. And this right here signals potential reversals. And the good thing about reversals is that if you're able to predict them, you can enter at very good spots in the market, very attractive spots in the market, and it can make you lots of money. And here, the RSI has many customizable settings. So you can, for example, change the period. So how many candles does the RSI use to calculate to make its calculations, and you can also change things like what is our limit for our overbought and oversold conditions, and so on and so on. But now let's jump into TradingView and take a look at how to use the RSI. Alright, so right now we are in TradingView and we are looking here at Bitcoin, as you can see up here, and we are on the 4-hour time frame, which means that every candlesticks on this chart represents 4 hours. But the RSI indicator can be used on pretty much all time frames. You can use it on the 4 hour, 1 hour, 15 minute, even 5 minute, and so on and so on. And I can also just mention that most of the indicators I will use in this course are completely for free. However, for some indicators, you will need TradingView Premium. But don't worry, because I do have a special link. You can use this link to try out TradingView Premium for free for 30 days. And then if you later on after the trial decide that you want to upgrade and stay with Premium if you really like it, you will get a $15 bonus. But as I said, don't worry, for most indicators you can follow along on the free plan as well. And the RSI is one example of a free indicator. So let's begin here by taking a look at how to open up the RSI. To open up this RSI, you want to navigate up here to the Indicators tab in TradingView, and then you simply type in RSI. And now you can see that multiple RSI indicators appears here on the chart. We have one called RSI Divergence. Remember, Divergence is one of my favorite indicators, but you can see that we have some indicators under technicals here, and then we also have lots of indicators under community. And all of these indicators are different versions of the RSI that is created by the TradingView community. So it can, for example, be RSI indicators with slightly different settings. Remember, I will soon show you guys how you can change the settings of the RSI to potentially improve it. But you have tons of different RSI indicators to play around with. As I said, I think most of them are free, but some you need TradingView Premium. But for now, let's just open up the normal relative strength index indicator. And just like that, you can see that the RSI indicator appears here at the bottom of our screen. And as we learned earlier, you can see that we have values marked right here. This is the 70 line. And when the RSI is above 70, we say that the RSI is overbought. And when the RSI is below this 30 line, we say that the RSI is oversold. So, for example, as you know, the RSI measures momentum. So if you look, for example, here, you can see that we have extreme high values on the RSI. You can see right here, the RSI is above 80, which means that it's very overbought. And you can see that when the RSI is very overbought, this will mean that we have lots of momentum in the market. So you can see right here, when we see strong overbought conditions, this means that we have strong momentum. And remember here, momentum is basically the speed and the strength of price movements. So when you see lots of speed and strength in the market, you will have high values. But when the market is very calm, like right here, you will have very sort of values close to 50. And let's just quickly take a look at an example in the opposite direction. When we see strong moves to the downside, like right here, we will see very low values on the RSI. But now I want to talk about one of my favorite use cases of the RSI indicator, and that is something called RSI Divergence. So RSI Div for short. And what we're looking out for, and when we're looking out for RSI Divergence, is that we're looking out for the price going in one direction and the indicator going in the other direction. So I want you all to focus on this high right here. You can see that we have one high right here, then we have a higher high. And if you look at the RSI, you can see that we have one high right here, and then we have a higher high. So in this case, the RSI and the price goes in this in the same direction. But if we look at the other high right here, you can see now the price prints yet another high, but the RSI prints a lower high. This right here is an example of an RSI divergence and indicates a reversal to the downside. This is what is known as a bearish divergence. Very important to be able to spot. And now, once again, if you look at the price right here, you can see that the price goes in one direction. We're printing consecutive lower lows. But if you look at RSI, you can see that the RSI prints consecutive higher lows. This is the opposite of what we just recently talked about. This right here is what is known as a bullish divergence and indicates a reversal to the upside. Yet again, if we look a bit to the right here and look closely, we can see that the price once again prints, higher highs, right? While the RSI goes in the opposite direction. This right here is a bearish divergence, and we can see that recently the price have been seeing a move towards the downside for Bitcoin. But alright, so now then, what are the best RSI settings? How can we change the settings of the RSI to potentially improve it, and as a result make more money? Well, for this part, I have actually changed the time frame to the 15 minutes. Remember, you can use the RSI on pretty much any time frame. But here, to change the settings of the RSI, we do want to go down here to where it says settings, and you press right here. And the first thing I do want to mention here that now I'm going to show you some of my favorite settings. But when it comes to settings and when it comes to what RSI indicator people use, remember when we look here in the indicators tab and search for RSI, you have tons of different RSI, RSI versions. You have tons of different settings. So all traders will, prefer slightly different settings. But now I'm gonna show you guys, some of my favorite settings. And the first thing I do want to do is that I actually want to go to the style tab here and uncheck the RSI based moving average. The RSI based moving average show you a line here, a yellow line, which is the average of the RSI. And I do think the standard setting here is that the length here is 14. But I do want to uncheck this one. I also like to uncheck the background fill here to see it more clearly. And I tend to, use a black RSI. I think it's super clear. So I changed the aesthetics to something like this, but you don't have to do this. But now you want to go to the inputs tab. And when we are on a shorter term time frame, like for example the 15, one thing you can do is that you can actually change the length of the RSI. You can see the standard setting is that the RSI uses 14 in length. That means that the RSI uses 14 candles to make its calculations. But in order to have a much quicker and much more responsive RSI, you can change this value to around 7 to 10. And to show you guys clearly, let's change to 7 right here. And what I'm also gonna do is that I'm actually gonna go to style once again here, and I'm gonna change the upper band here to 80, and I'm gonna change the lower band here to 20, because now the RSI will focus on the very extreme values. So now in order to have overbought or oversold, the momentum has to be very extreme. Another setting you can use is this one right here where it says calculating divergences. But when you check this one in, you will see multiple divergences appearing on the chart. You can, for example, see that we have bull divergences here and bear divergences here. But one problem with this setting is that you will get many false signals. So I highly recommend to learn about divergences on your own, definitely before you start using that setting. So I'm actually good for now, and I'm gonna press OK. So here, one thing, as I said, that I like to look out for are divergences, and especially divergences when we see the price, when we see the RSI either dipping below 20 or above 80. So for example, right here we have a super clear divergence. You see the price prints one low and then a lower low. You can see the RSI prints one low and then a higher low, and we even had the very bearish momentum here below 20, right? Same thing true right here. We have a high and a higher high. You can see the RSI is in this case above 80, and then we see this divergence from this high to this high. So this right here is a bearish divergence. This right here is a bullish divergence. But here, and this is very important, in order to use indicators effectively, it's important to not rely on the indicators on their own. You need to combine them with other things like price action, like market structure. So when you have the time, I highly recommend to check out this course right here. This is my full course on price action, and it will make you guys so much more effective in using the RSI indicator. Alright, so the next indicator we're gonna take a look at is called the MACD for short, or in other words, the moving average convergence divergence. This right here is one of my personal favorite indicators of all time, and when you really understand the MACD and learn about some special settings, it's usually one of these indicators that you can't really do without. At least for me anyways. But what is the MACD indicator? Well, the MACD indicator is an indicator developed by Gerald Apple in the late 1970s. And this right here is just like the RSI. It is a momentum indicator, but it can also be used as a trend following indicator. But I mainly use it as a momentum indicator. I think it's a great momentum indicator. But how does it work? Well, the MACD actually consists of three different things. It consists of the MACD line, the signal line, and the histogram. And I think it's much easier to just show you guys these lines than to talk about them here, so I will keep it very short. However, one of the most common use cases of the MACD is to use, when MACD crosses above the signal line, it's an indication of bullish momentum, and when the MACD crosses below the signal line, it's an indication of bearish momentum. But in my opinion, this is a way too simplistic view of the MACD, and you can use it in so many better ways. I will show you guys a few in this video. And just as with the RSI, you can of course change the settings. One of my personal favorite settings is a setting called 3-10-16, and I will show you exactly how to achieve these settings in this video. But right then, so now let's jump back here into TradingView. I'm currently looking here at gold, and we are on the 1 hour time frame. Throughout this video, as I have already mentioned, I will use a variety of time frames and so on, just to show you guys that most of these indicators can be used on all time frames. But now, to open up the MACD indicator, you want to navigate up here to the indicators tab, and you simply search for MACD or MACD. And just as with, for example, the RSI indicator, you can see that we have a few built-in indicators, but we also have tons of different settings and strategies and so on that is built by the TradingView community. And this is actually one thing I really like about TradingView. We have such a big community in TradingView, so you can, traders help each other, they build, tools, they share tools. So it's a, I think it's the largest technical analysis community. And as I said, if you want to get TradingView Premium, I do have a special link. But now let's begin by opening up the normal moving average convergence divergence, and just like that, you can see that the MACD indicator has appeared here in the bottom of the screen. And let's actually begin here by just maximizing the MACD indicator so we can clearly understand the different parts. First of all, we have the blue line right here. This is the MACD line. We have the orange line right here. This is the signal line. And then we have these sort of mountains and valleys. These right here are called histograms. And what you can maybe already notice, you can actually try to do this on your own. When you look at this chart, do you see any pattern between the lines and the histogram? Well, if you look really closely, you might be able to notice that when the MACD is below the signal line, we will have these valleys, and when the MACD line is above the signal line, we will have these mountains. And this is basically how the MACD indicator calculates momentum. When we see, strong spikes where the MACD line is far above the signal line, we will have lots of momentum. And this right here is a little bit too, simplified. If you really want to dive super deep into the MACD indicator, I do have a full MACD trading course right here on YouTube. I will make sure to link it in the video card and the description. Make sure to save that video for a watch later if you really want to master the MACD. But for now, all you need to notice is that once again, the MACD measures momentum. So when we see strong momentum moves like right here, you will see strong and violent moves on the MACD to the upside. And when we see strong moves to the downside like right here, you will see lots of bearish momentum on the MACD. But right, so now before we take a look at how we can actually use the MACD to trade and hopefully make money, I do actually want to change a few settings. And to do this, I want to go down here to the settings tab for the MACD. And here, make sure to really pay attention because we do have quite a few settings to change. The first setting is what is known as a fast length, and the second setting is what is known as a slow length. And these two together creates the MACD line. And what I'm gonna do here is that I'm gonna make the fast length much faster. So I'm gonna change it down to 3, and I'm gonna change the slow length down to 10. This will make the MACD much more sensitive to price movement, and that is, especially good for short-term trading. Right now we are on the 1 hour time frame, but you can use these settings, if you are day trading as well, and it can actually be useful in the longer term too. As for the source here, you can keep it at close or even use the OHLC4 divided by 4. The difference is not huge here, so I'm gonna keep it at close. As for the signal smoothing, however, we do want to change the signal smoothing to 16. We want to keep the oscillator MA type to EMA, and we want to change the signal line to SMA. These settings right here are known as the Linda-Raschke settings, and we can use these settings to find strong momentum moves and trade the pullback following these moves. So let me show you exactly how we can do this. Well, what we are looking out for after you have these settings, make sure to double check, rewind the video if you need to double check that the settings are correct. It's very important. But what we're looking out for here is that we're looking out for a strong momentum move, and to find these moves we want the MACD line right here to be much higher than the previous peaks. So for example, we have a peak right here, we have a peak right here, we have a peak right here, and you can see that this recent move towards the upside is much higher than the previous peaks. And this right here is our first signal to pay attention, because when we see after this momentum move, what we usually see is that the price starts to pull back a bit. This is where the price goes in the opposite direction of the move, and this is exactly what we're looking out for. We're looking out for a strong momentum move, then we're looking out for a pullback, and what we want to do is that we want to buy this pullback and catch the next move to the upside. And here you might wonder, how do I know when to enter this trade? Well, there are tons of different methods, and one method is to use something called chart patterns. Another method is to use something called candlestick patterns, and don't worry, because later in the course I will show you guys 2 indicators how to automatically detect both chart patterns and candlestick patterns. But for now, we need to do it manually. And by the way, I also highly recommend to learn about doing this manually, because the indicators, while the indicators can be super useful, they are, not perfect, and sometimes they can make false signals or weak signals. But for example, here we actually had something called a bull flag, because as you can see right here, we can define this pullback by, a support and resistance line, something like this. And a bull flag is when we have a move towards the upside, then the price start to pull back like this, and then we're looking out for a breakout to the upside. And the most common way to enter is to enter at the breakout right here. You can also try to enter at the support of the flag, especially when the price dips below support quickly like this. This is what we call a failure test pattern, but the most simple entry is to enter at the breakout. So in this case, the breakout is this candle right here. So just as a trading example, we can maybe, enter our long position right here. The stop loss is usually placed below the low of the flag, and using a risk to reward ratio of 2, your trade would have looked something like this, and you would have locked in some nice profit. Alright, so now it's time to talk about the Fibonacci retracement indicator. This right here is a tool that are very popular amongst beginners because it's relatively simple to use, or at least it gives an impression that it is simple to use. But what many people do wrong when it comes to the Fibonacci is that they don't know where to actually draw the Fibonacci. I will talk more about that soon, but for now let's just take a look at the basics of this very nice indicator. First of all, the Fibonacci retracement comes from mathematical ratios from nature. There is actually super fascinating things about the Fibonacci. You will actually find these ratios that we use in trading. You will find them in natures, in things like seashells, in galaxies. It's actually super fascinating. You basically find these numbers pretty much everywhere. But the reason they are called Fibonacci numbers and Fibonacci retracement is that the sequence of numbers were, I think it was popularized by Fibonacci, a guy called Fibonacci. But they were discovered actually much earlier, I think in India. Feel free to correct me if I'm wrong here in the comments. But some of the most important ratios that you need for trading are a ratio called 38.2 and 61.8. This is another word for this is 0.382 and 0.618. These numbers are very key, and you also have this simple 50% number. The 50% number is not a Fibonacci number, but it's still important, and that is for basic, I would say basic geometrical reasons. It's just, a fact that trends, in order for a trend to trend, the pullbacks will on average be around half the size of the impulsive moves. So if we have an impulsive move, the pullback tend to be around half the size, but more on that later. Because here, one of the most important things you need to know about the Fibonacci is that you draw them from swing high to swing low to find reversal areas. And how you draw them depends on if we have an uptrend or downtrend. So if we have an uptrend like this, you draw it from swing low to swing high. And if we have a downtrend, you draw it from swing high to swing low. And don't worry if this sounds complicated, it will be so much more clear when we jump into TradingView. But here, one zone you need to pay extra attention to is the golden zone. And the broadest definition here is that it's in between 38.2 and 61.8. Some traders define it to be more correctly between the 50% and 61.8%. But I would say that the most broad definition and the most beginner-friendly definition is to define it all the way from 38.2% to 61.8%. And we can, as with all indicators, we can customize the settings of the Fibonacci to make it more clear to use, more simple, more clear to use. Because remember, what is the goal of TradingView indicators? Well, the goal is to make the chart easier to read and make it easier and more clear to analyze. We want clarity on our charts. But right, so now let's jump back into TradingView. We are right now on the daily time frame and we are back on the Bitcoin chart. And here, this is actually one of my all-time favorite examples when it comes to Fibonacci. Actually, when it happened, it felt like too good to be true. Fibonacci just worked so well during the Bitcoin bull run. This was the bull run from all the way back here in 2021, but the Fibonacci retracement worked so well right here, and I will show you exactly how to draw it. But first of all, where do we find the Fibonacci retracement in TradingView? Well, to open up the Fib retracement, you go to right here where it says GAN and Fibonacci tools. You press on the button and then you press right here on Fib retracement. Then what I want you guys to do is to just draw out the Fibonacci on a random spot on the chart, because first and foremost, we need to, of course, understand what these numbers mean. You can see we have a number, we have 1, we have 0.786. Here we have the 0.618 that you remember is very important. Here we have the 0.5. But what does these numbers mean? Well, these numbers are basically percentages. So for example, this number right here simply means 78.6%. And for example, this number right here basically means 38.2%, and so on and so on. And what these numbers tell us is how much has the price pulled back from the original move. So how we draw these levels are basically like this. Let me actually draw out a trend right here. So if we have a trend that looks something like this, what these numbers basically tell us, let's use the Fibonacci tool again, is that we draw it from a swing low to a swing high. So as you can see, we draw the Fibonacci from this point all the way up here, and then we drag it to the right here. And what the Fibonacci tells us is how much have the price pulled back compared to the original move. So if we have a trend that looks like this, you can see that this right here is a very small pullback. This, if the price pulls back to here, it means that it has retraced 23.6%. Sorry for the ugly writing, but I hope you can see it has pulled back only 23% of the original move. But if the pullback is deeper, so if it pulls back all the way down here to the 0.618, now it means that this part right here is 61.8% of the whole move. And the magic with the Fibonacci comes from that most of the time the pullback will be in this area between 0.382 and 0.618. So this area right here is the most important area. And now let me actually show you guys how you can change the settings to only have this important area known as the golden zone on your chart. And to do this, let's actually delete this one right here. The step-by-step is that you use your Fibonacci tool, you draw it out, then this window will appear right here, and you press on settings. Now you need to do a few things. What you first need to do is that you need to uncheck the 0.236, the 0.5. You want to uncheck also all of these. So the only numbers you want to have on the chart is 0, 0.382, and 0.618. Then what I like to do is to make this one the same color as the one above, so this color right here, and then I change this zone to gold, so that we remember that this right here is the golden zone. And this is pretty much all you need to do. Then you press OK, and now we have our golden zone Fibonacci. But now we might wonder, okay, so how do we do this correctly? Well, remember what I did before. First of all, we need to define the trend right. You can see right here we have a clear uptrend because we do print higher highs and higher lows. And remember what I said, most of the time the Fibonacci, the price will retrace to the golden zone. So if we take a look at this first move right here, you can see that the price went up, then it retraced to the golden zone, and it reversed to the upside. Next, we can once again repeat this process, right? So we can use our Fibonacci again. So we draw from this low to this low. Once again, the price reversed in the golden zone. We can repeat this process once again, this low to this high. Once again, the price reversed in the golden zone, and so on and so on. So here you can see multiple examples of the price reversing in the golden zone. But now you might wonder, is this enough to take a trade? Well, the answer is no. As with pretty much all indicators, you want to combine them with other things, like for example, as I said, price action. And also, as I have mentioned earlier, you want to learn about market structure. Learning about market structure is super important. You will not be able to find the trends in a good way without it. But don't worry, because I do have a full market structure trading course right here on YouTube. I will make sure to link that course in the video card and the description. But here, one example of how you can use market structure and price action to trade right here would actually be, let me first of all draw out a support and resistance right here. You can see here the price saw resistance, we broke resistance, we flipped the previous resistance to become support. Also, remember that this point right here was indeed in a golden zone. So now we have a support level, we have a golden zone, but last but not least, right here, we actually had a bullish candlestick pattern. This right here is what we call a bullish engulfing pattern and indicates a move towards the upside. So here we had three factors being bullish at the same time, and this is often enough for us to take a trade. But as I said, don't worry, because later in this course you will learn about candlestick patterns, you will learn about support and resistance, and you will also learn about something called the ATR, and that can really help you place the perfect profit targets and stop loss levels. Alright, so now it's time to take a look at the ATR indicator. And the ATR indicator can be a super useful tool. It can help you with key things like, where should you set your profit target, where should you place your stop loss, but it can also help you identify, when should you enter the market, when should you buy, when should you sell. Overall, it's an indicator you really need to know about. And the basics here of the ATR is that it is an indicator that measures volatility. And now you might wonder, what is volatility? Well, in very simple terms, volatility is how much the price moves on average. So if we have two uptrends and we have one uptrend that maybe looks something like this, you can see the price moves up and down around its average, but not too much. And then we compare it with a market that looks like this. You can see the price moves up and down a lot. They are still, moving in the same direction, and on average they are moving the same. But in this example, we have an example of low volatility, and in this example, we have an example of high volatility. So the basics of the ATR is that it's a volatility measurement tool. And this indicator was actually also created by J. Wells Wilder in 1978. And as I said, it measures market volatility. And in very simple terms, when we have a higher ATR, this means that the market is moving more on average each period. So, or in other words, we have high volatility. But when we have a low ATR, this means that the market conditions are calmer, right? So low ATR, low volatility, high ATR, high volatility. And traders use the ATR, for example, to set, realistic stop losses. But as I said, you can also use the ATR to find your target levels, and there are many more use cases as well. When it comes to the settings for the ATR, the standard settings here is to use 14 periods. This right here is the exact same standard settings as the RSI, but we can adjust the length, and we can also change some other ATR settings to potentially improve the indicator and as a result make more money. But right, so now let's actually jump back here into TradingView. We are still looking at the exact same chart as we looked at when we used the Fibonacci tool. And let's begin here by taking a look at how to open up the ATR indicator. Well, to do that, you want to navigate up here to the indicators tab in TradingView, and you simply want to search for ATR. And as with all other indicators, when we search for ATR, you can see that there are tons of custom built ATR indicators, by the community. All of these have different settings, and they have, they are built in different ways. But for this course, we're going to use the normal average true range indicator. So let's open this one up. And as you can see, now the ATR indicator has appeared here in the bottom of our chart. And the first thing I want to do, I just want to change the settings a bit here so you can see the ATR more clearly. I'm just going to increase the length, the width here of the ATR line, so hopefully you can see. And now let's take a look at how to read the ATR. Well, to do this, let's actually zoom in on this point on the chart, because as you can see, the ATR was much lower down here when the price looked like this compared to up here, where you can see that the ATR was all the way up here. And in simple terms, that is because the volatility was much higher up here. Or in other words, remember what the volatility is. That is how much is the price moving on average. So how we read the ATR is like this. You go down to a specific candle. Let's say that we're looking at, let's say that we start by looking at, maybe this candle right here, where we didn't have a lot of volatility. What you do is that you take your mouse on this candle, and you can read here to the right, I hope you can see, it says 910. And that means that during this candle, the average price movement on a candle, remember we are currently on the daily time frame, so the average price movement on a day during that period, the period right now is 14, but the average price movement was 900. But if we instead look at, for example, the candle up here, you can see during this period we have much more violent and much more volatile price movement. So we do expect that we have a much higher reading on the ATR. And if you take a look at the ATR during that green candle, we can see that here the ATR was 3,600. So during this period, the Bitcoin price moved $3,600 on average. And this is how we read the ATR. We take a look at the ATR, and that is how much the price moved on average during that period. But now guys, let's take a look at how we can potentially change the settings to take, better decisions. And to change the settings, we go here to where it says settings down here, and then we want to navigate to the inputs tab. And here we have a few settings we can change. The most important setting, I would say, is the length setting. And this is how many candles does the ATR indicator use to make its calculations. So for example, if we have 14 right here, it means that the ATR uses 14 candles to calculate the volatility. And here, one of my personal rule of thumbs when it comes to the ATR indicator is that I like to keep my indicators consistent. So if I, for example, have, if I'm using the RSI indicator and have 14 on the RSI, I tend to want to use 14 on the ATR as well, because then I know that, my indicators are calculating both momentum and volatility on the same length. But let's say that you are more of a short-term trader, maybe you are day trading, maybe 5-minute candles or 15-minute candles, then it might make sense to actually change down the length. And here I recommend the same lengths I talked about when we talked about the RSI indicator. So you can go anywhere from around 7 up to maybe 10. But let's change to 7 right here. And now you can see that the ATR will be a little bit more volatile because it will only use 7 candles to make its calculations. But if you are a long-term trader, maybe you are swing trading, or you might even be investing, then you might be interested in periods from maybe 20 all the way up to 50 periods. It really depends on, first of all, what time frames are you using, but also how many candles do you trade in average? If you're a trader that maybe, you know, only jumps into a trade, waits like a few candles and then jumps out, then, you know, it doesn't make sense at all to use 50, you know, calculate the volatility of 50 candles. Then it makes much more sense to have a shorter span, maybe 7, maybe 10. But for now, let's keep it on 14. The next thing you can change here is the smoothing, and the RMA was the original calculation method. So this is actually, you know, the calculation method I do recommend. But if you use a shorter time frame, some traders actually opt for the EMA. This stands for exponential moving average. This is a common standalone indicator, but you can definitely use the EMA here if you are going for the shorter term settings like the 7 or like the 10. But for this video, I'm going to keep it super simple. I'm going to use length 14, and I'm going to use the RMA. So let's press OK here, and let's take a look at how to use the ATR indicator step by step. But alright, so now then, since we are using the same example as what we did when we used the Fibonacci indicator, let's actually quickly draw out our Fibonacci and take a look at how we can combine the Fibonacci indicator with the ATR. So let's once again go up here to and use our Fib retracement, and remember how we draw the Fibonacci. We draw from swing low to swing high. We also right now are using the golden settings where we have only the golden zone on the chart. But let's take a look here. So we saw this move towards the upside, and remember what we're looking out for is that we're looking out for the price to pull back, and what we want to do here is that we want to buy the pullback and catch the next move to the upside. And in order to find precise entries, one of my favorite methods is to use candlestick patterns. And later on in this video, I will show you an indicator that automatically detects candlestick patterns. But for now, we have to do this manually. So what we can see right here, by looking at these candles, you might wonder, how do I know which candles to use for entry? Well, if you know about candlestick patterns, you can actually see that these two candles together creates something known as a bullish engulfing pattern. And a bullish engulfing pattern is a bullish Japanese candlestick pattern indicating a move towards the upside. So what I'm going to do here is that I'm going to enter on this candle close. And what do I mean by candle close? Well, this is when the candle closes. Very simple. So we enter at the candle close. But now is where the ATR comes in, because we want to use the ATR to find when do we lock in our profits and when do we sell if the price starts to go against you. And one simple rule of thumb you can use here that many traders uses is to set the stop loss around 2x the ATR. So what do I mean by this? Well, we go down here to the candle where we entered, and then we move down here to the ATR. And as you can see on this candle, the ATR was 3,400. So with a 2x ATR, that means that we should set our stop loss at 3,400 times 2 away from the entry. And you can see that by looking closely at the stop numbers right here. You can see down here it's 10,000, but we want to go down to 6,800, right? So using an ATR multiple of 2, our stop loss would be right here. And in this case, it actually might make some sense, because as you can see in this case, this will mean that we set our stop loss just below the golden zone. And remember from earlier in the course, the golden zone is the most common area for the price to reverse. So setting our stop loss below there is a good rule of thumb. And here you can even consider to actually move the stop just a tiny bit even lower to, you know, get some wiggle room. So even if this move didn't happen, maybe the price would continue to fall a bit here, touch the golden zone, and then bounce. If we have some wiggle room right here, we can allow for the price to do that and still make money. But for now, to keep it simple, let's just use the 2x ATR multiple. So we have 6,800. And as for our profit target, what we can use for our profit target is to also use an ATR multiple. And when we use a stop loss multiple of 2x, a common profit target multiple is 4x. And this you can either calculate on your own, so you take, 3,400 3,400 times 4, or a much more simple method is to simply use a risk to reward ratio of 2. Because when the risk to reward ratio of 2, this will automatically mean that this is 4x the ATR. I hope this makes sense, because this area right here is 2x. It means that if we double that area right here, it's 4x. So this right here is one of many ways to use the ATR. You can also use the ATR for something called position sizing. You can use the ATR for something known as trailing stop loss. You can even use it for breakout confirmation and so much more. But for this video, I think we are good right here. I do have a video on my channel where I go deeper into the ATR indicator. So make sure to check that one out if you have the time. And if not, make sure to save it for a watch later playlist so you can come back to that one when you feel ready to learn more about the ATR. Alright, so now it's finally time to take a look at one of my favorite indicators of all time, especially when it comes to finding important support and resistance levels in the market. And this indicator is the pivot points high and low. And this indicator can help you with many different things, but as I said, one of my favorite methods to use this indicator is for automatic support and resistance detection. And if you don't know, support and resistance levels are basically levels on the chart where the price either, tends to bounce. So a support level is a level where the price tends to bounce. So this right here is a support, and a resistance level is a level where the price fails to push through and bounces to the downside. So this right here is a resistance, right? And what this indicator can do is that it can automatically mark recent swing highs and swing lows on the chart. So we can find, for example, horizontal levels right here, but we can also, for example, find trends. So this indicator can automatically potentially find trends, and we can even find things like chart patterns when the price maybe moves like this in a sort of symmetrical triangle or in a pennant looking structure. This indicator is very versatile, and if you are creative, you can use it in many ways. And as I said, these levels act as support and resistance zones. And when it comes to the settings, don't worry, I will show you this step by step later. But one of my favorite settings is a setting called 20 for both the high and low points. And as I said, I will show you guys exactly how to do this. And what I like to do is that I look out for clusters of pivot points, because that tend to indicate stronger support and resistance levels. And one of the best ways to trade support and resistance is when the price breaks through. So if we, for example, have a resistance, this is one of my favorite patterns. When we see, a resistance, the price get pushed down, the price comes up once again, get pushed down, the price comes up once again, get pushed down. But what we can see here is that the price is printing higher highs into resistance, and this is a sign that the resistance might be getting weaker. And when the price eventually breaks through right here, this tends to be a solid entry level. And now I want to show you guys a clear example of this. Alright guys, so now we are once again back in TradingView. And let's begin here by opening up the pivot points. To do this, as always, we go up to the indicators tab right here. And now you want to search for pivot point, and then you want to search for high, low, or pivot point. I think pivot points. Yeah, pivot points high, low is the name. And once again, as always, we have many community built indicators. This one is not as popular as, for example, the MACD or the RSI, but we still have many community built indicators. And also here, I do think this one is available on the free TradingView plan, but I'm not sure. If you can't open up this indicator on the free plan, make sure to use my special link. As I have already mentioned, by using this special link, you can get 30 days of free premium. And if you eventually decide that you want to upgrade, you will get a $15 bonus. But hopefully this one works on the free plan as well, so everyone can follow along. But let's open up this one right here and close it out. And you can see that right away, you will see multiple significant points appearing here on the chart. But the first thing I do want to change here is because I have a white background, maybe it's hard to see the points here. So I do want to change just some visual settings. So I want to make this one white, this one white, this one black, and this one black. And now you can very clearly see the points. But one sort of downside of having the original settings is that, as you can see, we have many solid points on the chart, but many of these will not be that significant. For example, this point right here might not be too significant. This point right here might not be too significant, and so on and so on. So what I like to do in order to find, only the most significant points without losing too much information is to actually go up here to the setting tab, and I want to change the pivot high to 20 to 2020, and I also want to change the pivot low to 2020. By doing this, you can see that we have filtered out some pivot points, and now we only have the significant ones. But now you might wonder, how can we use these pivot points? Well, as I said, one of my favorite use cases is to use them as support and resistance. So for example, in this case, we can actually connect all of these pivot points right here. So we connect them right here. We can disregard the wick. You can see this pivot point right here comes from the wick here. And to keep it a bit more clear, I'm going to draw the support and resistance and include all of the real bodies of these peaks, right? So we include all of the real bodies of the peaks, and we drag this zone out. Next, we connect the lower pivot points, right? So we connect, once again, we can use the real body method. Here, when it comes to drawing support and resistance, some traders will say you have to use the wicks when you draw support and resistance, or some traders will say, no, you should only use the real bodies. But the truth here is that in real markets, support and resistance levels are very seldom these sort of perfect lines in the market. They are more often sort of broader areas, and it's usually not the end of the world, if you draw them a little bit incorrectly. The most important part, in my opinion, is that you are consistent when you draw them. You need a sort of method that, maybe you always draw from wick to wick, or maybe you only use candlestick bodies. But here you can see we draw out a line like this, and the most important part here, as I said, the most important part isn't how we draw the support in this case. The most important part is that you see we have one low here, we have a higher low, we have yet another higher low. So here we have higher lows into resistance, right? We even have a low right here. This low was not as significant to be, counted as a pivot point in this case, but we have yet another high low. And this right here is a textbook example of an ascending triangle, right? We have a triangle, we have a pattern that looks something like this. You can see this is this pattern right here. And when we break out, this is usually the level where we want to enter. So once again, now we can start to put things together that we have learned from earlier in the course. So we're going to use our long position. We enter at the candle close of the breakout. And here, if we want to, we can open up the ATR. We can then go down here and look at the value when the breakout occurred. So it was right here. We had an ATR of around 40. That means that we can use using a 2 times multiple of the ATR. That means, ATR. That means that our stop loss should be at around 80, right? So we drag our stop loss all the way to here. This is a stop loss of 80, and using a risk to reward of 2, our target would have been right here, and we would have locked in some nice profit. Once again, if we look a little bit more to the left right here, we can maybe see that we had another sort of pattern. Once again, if we connect these highs right here and we also connect the lows, we can see that in this case, we had like a symmetrical triangle looking pattern. And when we broke this one, we saw a strong move to the upside. And one interesting fact I can mention right here is that many TradingView indicators that are sort of automatically finding chart patterns. By the way, we will take a look at one of these indicators soon. But these indicators that, for example, automatically find patterns, they usually use pivot points high and low to find these patterns, right? That is just an interesting sort of bonus info for you guys. All right, guys, so now it's finally time to take a look at the auto candlestick pattern indicator. And candlestick patterns is something we have already, been using quite a bit throughout this course. But what this indicator simply does is that it automatically detects candlestick patterns. And candlestick patterns are patterns like hammers, dojis, or engulfing candles, and they can help us find much better entries in the market and as a result make more money. And here, each of the pattern is clearly labeled on the chart. The bullish patterns are blue, the bearish patterns are red. So when you see a blue pattern, that is a buy signal, and when you see a red pattern, that is a sell signal. Here it says, that the bullish ones are green and the bearish are red, but they are actually the standard settings. The bullish ones are blue in TradingView. And here you can also use it to set alerts for when these patterns appear. But one very important thing about using this indicator is that, trading based on candlestick patterns alone is not really a good idea. What you want to do is that you want to combine candlestick patterns with things like market structure, such as support and resistance, and you also want to combine it with general principles of, for example, profit targets and stop losses. And you already have a tool for that. You have the ATR. You can even combine them with momentum indicators as well. But now let's jump into TradingView and take a look at this indicator. All right, so now we're back here in TradingView and we are currently looking at Adobe on the daily time frame. And let's begin here by opening up the indicator. So once again, we go up here to the indicators tab, and what you want to search for now is you want to press a star, and then you want to type all candlestick patterns, and just like this. And for some reason, this indicator, some people in the YouTube comments have been having troubles finding this one. And some people, when they have trouble finding it, they can sometimes find it by searching for the indicator in their own language. So if you are not English or from the United States or using English language, try to type it in your own language if you're not finding it. But once again, we have many community built indicators, but the candlestick pattern indicator we are going to use is the built-in one by TradingView. So I want to open up this one right here and then press X. And as you can see, you will see that immediately you will have multiple signals appearing here on the chart. But what you also can see right away is that many of these signals will be false signals. So for example, this bullish engulfing pattern right here didn't really turn out to anything bullish. Once again, this bullish engulfing pattern right here, well, you saw a little bounce, but shortly after you saw a strong reaction to the downside. And this is when two important factors come in. First of all, you need to change the settings so you only see the signals you want to appear. And secondly, you need to combine these signals with some other tools that I will show you. But let's begin here by changing the settings. And to do this, we go up here to where it says settings. And the first thing you can notice is that if you scroll down, you have tons of different candlestick patterns. And here I highly recommend to only focus on the best patterns. And this will be a little bit subjective. Some traders prefer, patterns over others. But my favorite patterns includes, first of all, the bullish engulfing pattern, the hammer. I also want the shooting star. So let's scroll down here to the shooting star. And to keep it simple, I do have a few more patterns I like, but for now, I think you come a long way by, showing engulfing patterns, hammers, and shooting stars. So for now, let's uncheck this one. You can also use the inverted hammer if you want to, and let's see here if we can find the hanging man. So let's actually use these 5 patterns, and the next thing you can change, if you prefer to have the bullish signals as green, you can choose green right here. I'm gonna keep it at blue, to be honest. And one last setting that is pretty important, you can see it says detect trend based on. So now the standard settings is to use an SMA 50, and this one will actually filter out many false signals. And you can see that if you change here to no detection, you will have many more signals on the chart, but many of them will be false. So I actually tend to include this SMA filter because this will make the chart more clean. The chart will be easier to read. And remember, we use indicators to make the chart easier to read, not harder to read. But alright, so now we have a few, signals appearing here on the chart, but we still have too many signals and we still have many false signals. So what I'm gonna do now is that I'm gonna combine some knowledge from earlier in the course. So if you haven't watched, the earlier chapters in this course, I highly recommend to do that, because now I will go over these things in a relatively quick pace. So now I'm gonna first of all open up the pivot point high and low right here. As we did before, I'm gonna change the settings to 20, 20, 20, 20, right? We change this to white, black. We change this to white, black. And now we have the significant pivot points on the chart. What I'm also gonna do here is that I'm gonna open up the ATR indicator. I'm gonna change this one to become a little bit more thick, but I'm gonna keep it with the 14 RMA. And what I'm now gonna do is that I'm gonna look a bit left and see if we can find any clear structures. And one thing you can notice right here is that we had a low all the way back here. We also had a pivot point right there and a pivot point right there. And one of my favorite methods to find key support and resistance is to find these important pivot points and include them all. And now things are starting to look super, super interesting, because as you can see, both of these patterns, this right here is a BE, that stands for bullish engulfing pattern. This right here is an H, and that stands for a bullish hammer. Both of these are bullish candlestick patterns that indicates a bounce towards the upside. And these patterns become so much stronger because they appear at a key support level, right? We have a very important support. We see these patterns appearing right here. So that is a way for us to enter our trade. So let's take a look at how the trade could have looked like on this hammer example. We enter right here. As you know by now, you know how to use the ATR. The ATR was at around 8, meaning that we tend to have a stop loss of around 16 if we use 2 times the ATR, and with a risk to reward ratio of 2, our trade looks like this. And as you can see, this trade is still in play. It might not work out, it might work. We just need to wait to see if this is true. But this is a very important part about trading. Even though we might find, a bullish signal happening at a support level, it doesn't mean that the trade will succeed 100% of the time. Especially when we have this reward. When this reward is twice the size compared to what we lose when we lose the trade, we don't even have to win 40% of the time to still make money. So you need to really, already have the mindset that not all trades will succeed. However, here I do want to point one thing out, and that is that when it comes to hammer patterns, the most common way to set your stop loss is to set it immediately below the pattern, so somewhere around here. And in this case, we can see that our support area is also around this level. So in this case, it might make a bit more sense to have your stop loss right there. And this would actually make the 2-to-1 ratio, be somewhere around here, right? And in this case, you can see that we have pretty much already locked in our profit. All right, so now the time has come to take a look at a very impressive indicator. This right here is the auto chart patterns detection tool, and this indicator is pretty similar to the auto candlestick pattern, but what makes this one so impressive is that it's able to automatically find larger formations. And what you will notice later on is that this indicator actually uses the pivot points we talked about earlier in the course. But this indicator right here can pretty much find all chart patterns, maybe not all of them, but they can find pretty much all of the most popular chart patterns. Like for example, triangles, wedges, head and shoulders and flags. One of my personal favorite chart patterns is the flag pattern. And this indicator can be very helpful because it can help you save time by, finding the patterns automatically. And what it also does is that it actually highlights both breakout areas, and it also gives you automatic price targets for where you can lock in profit. Of course, you don't have to follow the automatic targets. You don't have to follow the automatic patterns either. But this tool can be, both used to, as I said, find the patterns automatically. But you can also use this tool to sort of see if this tool finds the same patterns you are finding, and so on and so on. Last but not least, you can create alert notifications when new patterns are detected. All right, so let's jump back here into TradingView. Right now, I'm looking at the NASDAQ 100, or for short, US 100, and we are once again back on the daily time frame. And as you can see, right now, I currently already have the indicator on the chart right here, and you can see that this indicator automatically identified this beautiful double bottom pattern. It automatically identified the target, and as you can see right here, we locked in some nice profit. If you didn't know, you can of course trade things that are going up, but you can also make money from the price going down. This is what is known as shorting, or in other words, going short. But now, when it comes to finding this pattern in TradingView, this is very important. In order to find this pattern, you need to search for auto chart patterns, or maybe it's called all chart patterns. And I actually think that this indicator, at least for now, is only available for TradingView Premium. So if you want to follow along in the rest of the course, I highly recommend to use my special link. As you probably already know by now, I'm sorry if I have been, putting this link out multiple times, but you can use that link to try TradingView out for TradingView Premium out for 30 days. And if you later on want to upgrade, you will get $15 bonus. So if you want to follow along for the rest of this indicator, make sure to use that link so you can get this indicator for free for 30 days. But you want to click the all chart patterns indicator right there. Then you want to press on X. And what I recommend later is that you want to change a few settings. So you go up here to the upper left corner and you press on settings. And in order to not make this indicator overwhelming, I recommend to focus on a few patterns. So either you can maybe focus on double tops and double bottoms, or maybe you want to focus on, bull flags and bear flags. But for now, I do want to keep it simple and focus here on double tops and double bottoms. And to keep this very simple, I'm going to keep the patterns at all. So I'm going to show all patterns, and I'm going to show all price targets as well. Now we're ready to go down here and press OK. So now then, finding these patterns on your own is super simple, and you can, trade them. So for example, right here, we had a beautiful double bottom. You locked in some nice profit right here. But my strong recommendation, just as for pretty much all things we have covered in this video, is to not rely blindly on chart patterns. You always want to combine multiple factors. The more factors you combine, by the way, this is also known as Confluence. The more factors we combine, the more, we tilt the odds in our favor, and the more likely that we make money. So here, let's use some of the tools we have been using earlier. So let's open the indicators tab, and let's open up the RSI to check the momentum of this double bottom. This double top. Remember, right here, we have, we have one high, and then we have a high at the same level, almost like a higher high. So here the price goes sideways. But if we look here at the RSI, we can see that the RSI indicator prints lower highs. This right here is another form of bearish divergence and indicates a move towards the downside. It's not as strong of a signal. If, you know, this top right here was a little bit higher, the signal would have been stronger. The signal is stronger when we have higher highs on the price and lower highs on the indicators. But even if we have the price on the same level and lower highs on the indicators, this is still a form of bearish divergence. So here we have two signals. We have bearish divergence and we have a bearish chart patterns, but we are not done here. Next, what we also can find if we look here at the entry level. So where you want to enter the double bottom, so here we have a double bottom, where we want to enter is actually when the price breaks this level. And if you look closely at the price action when we broke this level, here we actually saw a bearish engulfing. So this right here is a bearish price action signal, also indicating a move towards the downside. So here we have bearish divergence, that is one signal. So 1, we have bearish divergence. 2, we have a bearish pattern, a bearish chart pattern. 3, we have a bearish candlestick pattern. So here we have 3 signals happening at the same time, indicating a move to the downside. And here, once again, we can use the already built-in target, or maybe we can use some more tools we used in this course. Maybe we can use the average true range. So you already know how to do this. To check the volatility, we look at this candle. We go down. We see that the volatility is at around 425. So using a 2x ATR, right, we need a stop loss of around 850. And in this case, we have a bearish pattern and we are going short. So what we're going to use here is our short position. We enter right here, and now our stop loss is to the upside. And remember, we will have a stop loss of 850, so around here. And using a risk to reward ratio of 2, our trade would have looked something like this, and we would have locked in some really nice profit. But okay, so this course is getting super long, so I think I will wrap up right here. I do have a few more things that I would like to cover, but I don't really have time today, so I will make sure to save the rest of the presentation for our YouTube channel members. If you didn't know, we have an amazing community right here on YouTube where I share presentations like this one right here. I also share, you know, exclusive videos, some exclusive tools, and you will get more updates and so on and so on. So if you want to, you know, get access to exclusive content while at the same time supporting the channel, please consider becoming a channel member by clicking join down below. And now guys, in order to use trading indicators effectively, it's so important to learn about the foundations of technical analysis. So when you have the time, I highly recommend to check out this course next.